Assalamu alaikum everyone, welcome back. I hope you all are doing well. I'm here to discuss about a new topic in corporate financial reporting, that is provisions and contingencies. And in this topic, while discussing the details, I'll be talking about different types of contingencies and different types of provisions and what are the similarities among them. So without any delay, let's proceed towards our discussion, and starting with the definition of provision. So provision is an expected liability, but the timings and the amount of the provision is uncertain. So we cannot say it's a type of saving, but actually we are recognizing the provision about of upcoming liability which is expected in the future, but we are not sure when and about exact amount, but yes, we have an idea about it. So where do we disclose the provisions? So provisions are the part of balance sheet, and since this is an upcoming liability, so we mention it in the liability section of the balance sheet. What could be the possible reasons for provisions? So maybe the corporate restructuring, when you reorganize your organizational structure because of heavy losses. At that time, many upcoming payments are expected, so that could be the one source of contingent, or you can say provision. Then the expected warranty claims on your sold out products, and if the warranty period is still on, you can expect these damaged products to come back for warranty. Then environmental cleanup penalties that you need to incur. Then litigations for which are not in your favor, and you are expecting to pay the fines for those litigations. And onerous contracts, these are basically all those agreements in which the cost of the contract which is expected to fulfill the contract or fulfill the agreement is higher than the benefit which you are expecting from this contract. So in this case, the difference between the cost and the economic benefit you are getting, cost is more, you will be having an expected amount of losses, so that will generate a liability for you in the future. Moving on towards, these are the reasons, or you can say the sources of provisions. So let's take one of the example for the provision, that is warranty. So this is about a vacuum cleaner seller or the manufacturer of the vacuum cleaners. When they sell these vacuum cleaners, they offer a 2 years warranties for these cleaners. So if during the 2 years something happens to the product or it needs repair, the client will bring it back. So if the product become faulty within the warranty period, the company will either repair it or they will replace the faulty part of the product. So basically, when you sell the vacuum cleaners, there is potential liability of warranty liability attached with it. So why do we record the warranty liability when we sell these vacuum cleaners? Why not when the client actually brings the vacuum cleaner back for the repair, we incur the cost on the repair and then we record our expense or payment? Why do we record it with the sales? So this is the question for which I'm going to answer you, that why doesn't company simply report an expense to service the warranty? Why do we need to create the warranty liability? So the reason is it violates the matching principle. What does it mean? It means that when the client will bring back the product for the repair, and if at that time you record warranty expense, this is warranty expense. Let's suppose you sold the goods in 2018, but the client is bringing back the product in 2019. So if you do not create the warranty liability, you have to record the warranty expense in 2019. But it violates the matching principle. Matching principle says that expenses should follow the revenues. The economic benefit, the year in which you are getting, the same year you should record the revenue. So the economic benefit comes from the sales of these vacuum cleaners. So warranty expense should be recorded in 2018, not in 2019 when it is actually happening. So in order to avoid the violation of matching principle, when company sells the product at the same year, at the end of the year they record their expected warranty liability by debiting warranty warranty expense and crediting warranty liability. And when the client bring back the product, then the liability decreases. In 2019 the warranty liability will decrease. So one reason is matching principle. That's why we have to record the provision rather than when actual expense happen. The second principle which we violate, that is known as conservatism principle. Conservatism principle states that the company should not understate their liabilities, means they should not record their liabilities and expenses less. So if we do not record this warranty expense in the year 2018, we are actually violating the conservatism principle, right? So in order to avoid the conservatism and matching principle violation, we are required to maintain the warranty liability and expense in the year when you sell the good, not when the client claim for the warranty. So if the company has incurred obligation as a result of selling the vacuum cleaner, then the related liability and the warranty expense that follows should be recognized immediately. Okay, so this one is the reason why do we follow the provision. Why don't we record the expenses when they really happens? Now since we maintain the provision, as I said, it's we don't exactly know that how much amount of the provision will be there. So when we record the provision, or you can say these liabilities, we record them with an expected amount, with an estimated amount. This amount is based on the assumption by the management. So it might happen that, let's suppose the warranty liability which you have recorded in 2018 is, let's suppose, is for $10,000, but in 2019 the warranty claims which came, they were for $2,000, and in 2020 the warranty claims came for, let's suppose, $3,000. So altogether the warranty claims came for $5,000, right? But the warranty liability which we have maintained, that was for $10,000. We maintain more provision, more liability as compared to what actually happened in the future. So this is the condition of over provision. Same is the case, we might have under provision, like let's suppose in 2019 12,000 claims are coming, and in 2020 3,000 claims are coming, $3,000 of claims, so together it is 15,000. Now the liability was less but the actual claim came was more, so it's an under provision. So companies have some liberty in the figure they report in the financial statement. It's not a crime if you under provision or over provision, because it's an estimation, but estimation should be realistic. Under and over provision is a state of affairs. We cannot say it's a liability, it's an asset or expense. No, it's just a situation, it's a condition which might happen, and that's why we call it a situation. Okay, so what happen if we maintain less provision, or we can say we are in the under provision situation? So when you record the warranty provision less, so of course the warranty expense will also be less, right? In that year we were maintaining it in 2018, for example. So when the expense is recorded less, so our expenses will be understated, or you can say the losses in the current period will be understated. And what will happen if your expenses will be understated? Your net income or your net profit will be overstated, because you recorded less expenses, so it boosts the profit of the current year. And ultimately you have to correct it when actual expenditures will exceed the recognized provision, but in the future you're gonna correct it. So future period, when you will rectify this, then what will happen in the future, let's suppose in 2019 you have to rectify it, so your expense will be more, right? When it will be more, it will understate your revenue or net income in the future. So future period burdened with higher expenses, resulting in the lower profits in the future. So for example, management provided a provision of $100, but later they discovered it was actually 125. So they under provision with $25 because 100 they already maintained, $25 were less. So they have maintained an under provision of $25. Now what happened when there is a situation of over provision? So this is opposite to under provision. Your current period expenses are overstated, which understate, which reduces your current period profits. And expenses, because in the current period you recorded more expense, so in future you have to rectify it, so future expenses will be understated. And sometimes it is expected that companies, they record more expenses in the current period so that they can get a reversal of that in the future in form of correction. They do these situations when in future they are expecting losses, so they want to have other incomes in with reference to the correction of over provision. So for example, in 2018 company has good amount of revenue, but they know that in 2019 they are expecting less revenues, so in 2018 they might record more provision, more warranty expense or other expenses, whatever are they. So because the revenues are of good amount, so net they still have net income, but this warranty expense is recorded more because of over provision. Okay, then in 2019 revenues are less. It could be any reason, any maybe your product is outdated, you're facing more competition in the market, or some other stuff could be there which has reduced your revenue, so you was not able to earn good amount of revenue, but this over provision will be rectified in the future. So we cannot credit the warranty expense, but yes, we will have other income for the correction sake. So this other income is going to lift up the revenues of 2019 where actual revenues were actually less. So we call this situation as hidden or cookie jars reserve. This reserve has increased the future revenues because of correction. So management, they deliberate it over, sometimes it's not always the true situation, but sometimes management play these tricks that they deliberately overstate the amount of the write-offs. This one they are doing it deliberately so that in future they have reversals and then their profits will increase in the future. The intent behind the use of the big bath is to take the large hit in the earnings of the in current period, reduce the earning of the current period because current revenues are handsome enough, but in the future to get the reversal to look more profitable. But this situation cannot last longer. Companies can play with 1 year or 2 years, but ultimately this hidden jar will be broken. So under IFRS, how do we define the provisions? They say that a company must recognize a provision if the following situations are met. So what are the conditions? Number one, it's a present obligation. Present obligation means you're doing something at present because of which this provision is arising. So that obligation could be legal or it could be constructive. I'll explain in a while what is the difference between these two. And as a result, this obligation you have to record. So let's suppose something you did, you sold the goods. So when you sold the goods, this event happened, you sold it, so now it's your present obligation, you have to record it. Maybe you have done the breach of contract with one of the client and the client has filed a case against you. So the breach of contract happened and the case is filed in the court, and now you are expecting that in future you are supposed to pay some penalties. So it's your present obligation, you have to record the provision. The payment is probable. Probable means that you are more than sure that it will appear. So we can say it's not remote, it's more than not, means more than remote, you are probable that you have to make the payment. This is the second condition. And the third condition is you can estimate an amount. reliable amount you can estimate. If you cannot estimate an amount, how can you record the journal entry? So these three conditions are must in order to record the provision under IFRS. So let's have some more details about these three conditions, starting with its present obligation. So when I say present obligation, it could be legal or constructive, and you did something in near past because of which you are supposed to record this. So a past event that leads to a present obligation is known as obligating event. So as I said, you sold the goods on warranty, which were having warranty, so these sales of goods is an obligating event. You have reached a contract with one of the client, and so that's an obligating event. You have broken some environmental safety law and you're expecting that you will be given huge fines, so this breach of environmental law is your obligating event. So basically, obligating event is an event that creates a legal or constructive obligation, and therefore it results a company have no realistic alternative but to settle the obligation. It means you are more sure that you will be settling down this obligation in the near future. The obligating event has already arisen, means sale are done, breach of contract is done, breaking of law is done. We cannot say that we are planning to do these things in the future. No, obligating event is always a past event. And which type of obligations are there? It's either legal or constructive. Let's talk about legal. As I said, because of the law, because of the contract, because of some legal reasons, means if you break them, then the provision which you are maintaining, that is a legal obligation because of the law. Constructive obligation arises which are because of your company's past practices, normal policies of the companies, that you are expecting certain responsibilities, as I said, that sale of goods on warranty, or some other types of you can say contracts, but they are of regular nature, they're not because of the legal stuff. So here is an example: a retail store that has a long-standing policy of allowing the customer to return the merchandise within the 30 days period. So you can say the sale with return back guarantee, or you can say warranties. These are the example of the constructive obligations. The second condition is that the payment is probable. Probable means that more than likely you are sure that you will be asked to make the payment. So when you will make the payment, of course resources will go from your hands, so resources outflow is expected in order to settle this payment. So I will say that we are more than probable, when you are more than 50% sure under IFRS. So probable means that the probability is greater than 50%, and under GAAP it's greater than 80%. So if you say something is probable, you are expressing that you are more confident that it will happen, but because it's expected, that's why you cannot say we are certain. No, but it is probable. Okay. The third condition was the amount can be estimated reliability. In order to record the entry or to record the provision, we should have an amount. So they say that you should be able to estimate the amount for this provision. If, for example, the first two conditions are met, that there should be an obligating event and the payment is probable, they are met, but you cannot estimate the amount, then you cannot record this provision. But yes, you will be disclosing it in the notes to financial statements. Okay, so in order to record, these three conditions should be met, but if any of these condition is not, then you are going to record it in notes to financial statement. Now, how do we measure the provision? So under IFRS, the amount of the provision should be the best estimate, best idea by the management, that what expenditure you are required to make the payment to settle this obligation. how do you define best estimate? The amount that a company would rationally pay to settle the obligation at the end of the reporting period. Or maybe if they are not planning to pay, they will be transferring this task to a third party that they do it on their behalf. So this means provision for one-off event. One-off event means one-time event are measured at most likely amount, that most expected amount, like restructuring expenditures or environmental cleanup fines or settlement of the lawsuits. They are one time, right? Every time you don't breach these things or you don't break the law, so they are not of regular nature. So for them, you are going to take the most likely amount, that usually if somebody deals with such types of issues, how much fine they are supposed to pay, so that will be the best estimate. But if you have a constructive obligation which is of your regular nature of business, like warranties or customer refunds, then in that case we have a probably weighted average value, usually 2% of sales, 5% of sales. Some we have a measurement estimate that we use. So both measures are how do you calculate this best fit amount or this percentage. You usually calculate them by considering the present value concept, and you discount back your future expected payments, and you calculate its present value, and that present value you record as the journal entry, because payment will be made in the future. So that's why time value of money is involved in recording the provision. And in order to calculate the best estimate, the entity should take into account many other things, not only the amounts. There are some risk and uncertainties also involved, so we should consider them as well. So if we summarize it, in summary, when you are measuring the provision, firstly find out what is the nature of the provision. If it is a legal obligation, then in that case we will check usually how much fines are for such breach of contracts according to the law, and then we will calculate their present value and we will record the provision. If it is your constructive obligation, which is from the normal course of business, then in that case you will be calculating a probable value, like 2% of sales is warranty, 5% of sales, like that, based on your past experiences, and you will calculate its present value and then you will record the provision. Okay, let's move on towards some more details about the measurement of provision. So under IFRS, if your estimate is predicted, like let's suppose you find out that let's talk about legal provision, and you find out that sometimes the fine for breaching the environmental law is 2,000, sometimes it is 7,000, sometimes it is 4,000. Means you wherever you investigated, you get a different estimate, like none of the amount is appearing more than once, every amount is different. So they say that under the IFRS you take the midpoint to record your liability. So midpoint is 4,000, so you will be taking that. But under the gap, if the range is, this is the range, if the range is available, they say use the minimum amount to record the liability, so that there is no over provision. Okay, so this is about the measurement of the provision. Now since we are talking about liabilities, so which means expected liabilities, so we cannot ignore the concept of contingent liability. So contingent liability is a possible obligation, again, that arises because of the past event. In provision we call it as obligating event. Here we are using the word of past event, and its existence will be confirmed only when one event will happen which is uncertain. So its existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events which are not in the control of the company. There is another definition of contingent liability which says that it's a present obligation that arises from the past event, but we have not recognized it. Why? Because it is not probable. Probable means that an outflow of resources, it's not sure, so that an outflow of the resources means your economic benefits will be required to settle the obligation, but you are not probable. So when you are not probable, that's why you did not recognize it yet. Because if you remember, when I gave you the definition for provision, the second condition was it is probable, right? So if it is not probable, we will not record it, we will disclose it in the notes. Also in the provision, I told you the third condition where I said that we should estimate the amount, and if we cannot estimate the amount, we will not be able to record the provision, right? So we will be disclosing it in the notes. The same is the case over here. The amount of the obligation cannot be measured with sufficient reliability. So if we cannot measure it, we have not recognized it. Okay, but if not recognized does not mean that we do not mention it anywhere. We mention it in notes, in the disclosure to financial statement, not inside the financial statement. So examples are lawsuits, and we disclose them in the notes unless we are probable that the outflow will happen. So what is the relationship between provision and the contingent liability? So in journal, both of them are the types of liabilities. So we can say that all the provisions are contingent because they all are uncertain about the timings or the amount. Okay. In other words, you can say that provision is a liability, but we are not sure about the time or the amount. But the contingent liability, it's a possible liability. It's not 100% liability yet, because we are waiting for a future event to happen. If it happens, then it will be a liability. So the term contingent is used for the liabilities and assets. We also have contingent assets, but we don't have provision assets. Provisions are only the category of liability. So contingent is used for liabilities and assets that are not recognized, because their existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain events in the future, which are not in the control of the entity. In addition, the term contingent liability is used for the liabilities that do not meet the recognition criteria. So as I said, the three criterias are there. So if they are not met, we can say that they are contingent liability. If they are met, we will say they are provisions. Okay, because provision, we have to disclose it. Moving on towards the contingent assets, it's opposite to the contingent liability. It's a possible asset that arises from the past event, and its existence will be confirmed only by the occurrence or non-occurrence of one or more future events, which are not in the control of the company. When we have contingent assets, usually they arises from unplanned or other unexpected events, which will give rise to an inflow of economic resources or economic benefits. Contingent liability is an outflow of economic benefit, whereas contingent asset is an inflow of economic benefit. An example is a claim that an entity is pursuing through legal process where outcomes are uncertain, but entity knows that it's in the favor of the company. Disclosure, because it's contingent, so we cannot disclose it inside the financial statement, but yes, we have to disclose it in notes if inflow of the economic benefit is probable. Now here we are using the conservative approach. If you remember, when I gave you a few minutes back the concept of contingent liability, I said if it is probable, it becomes a provision and we record it. But if economic benefit of contingent asset is probable, if it is a contingent liability, we will record it inside the statements, right? But if contingent assets are probable, we disclose it in the notes. Fine. So when realization is certain, the related asset is no longer a contingent, and then we will report it inside the balance sheet as an asset. So remember, the differences between contingent liability and provision. Also, what is the recognition stage for contingent asset and contingent liability. Contingent assets are recorded inside the balance sheet only when we are certain about their availability, but if they are probable, we will be disclosing them in notes to financial statements. Contingent liabilities are recorded in the balance sheet when they are probable, okay, and we disclose them in notes to financial statement when we are not probable about them or we cannot estimate their amount. We have an example over here which we will be solving for provisions. This is an example for provision for warranties. Creative Technology Limited, a Singapore-based consumer electronics company, disclosed the following information regarding the warranty provisions in its 2011 annual reports. The warranty period for the bulk of the product typically range between 1 to 2 years. The product warranty provision reflects the management best estimate of the probable liability under its product warranties. Probable, so we will be recording them. Management determines that the warranty provision based on non-product failure, if any, historical experiences and other currently available evidences. So how do they record the provision? Because of these facts, like from the past experiences, how much product failure are there and how much current other information is available. Based on that, they have estimated the provision. Movement in the provision for the warranties are as follows. So we have the data for 2 years available with us. We have some requirements. They say make the necessary journal entries to record the movement in the provision for warranty account for 2010 and 11. So they say whatever changes are happening, record the journal entries for them. Also, they are asking you what is the difference between what is meant by provision made and provision written back. This is provision made and this is provision written back. I'll be explaining in a while. Also, they said what does provision utilized means. This is provision utilized. And describe what happened in 2011 regarding creative provision. They are asking for the ending balance of provision in 2011. So let's check out. At the start of the year 2010, the beginning balance of the provision account was 2,899, and in 2011 this balance decreased to 2,784. During 2010, what happened? Company has recorded provision made means new provision is recorded, like warranty expense debit, warranty liability credit, or provision credit. Okay, so in 2010 they have recorded the provision of $1,915, but in 2011 they have written back the provision. If you remember, I told you that written back provision means that you record other income, because we cannot credit expenses to reverse the entry. We will be recording it as an other income. Provision utilized means that how much actual claims happens during the year. So in 2010 it was 2030, and in 2011 $711 claims came back. And then we have the ending balance of both years. The ending balance of 2010 becomes the opening balance of 2011. So we are supposed to record the journal entries. Of course, we don't record any journal entry for opening and the ending balance. Journal entries are only for provision made or provision written back and provision utilized. Okay, so let's find out. Firstly, we will do for 2010. So in 2010, I'll just show you both pictures. Yeah, here. Yes, okay. So in 2010, firstly, company has made the provision of 1,950. So warranty expense gets debit. Usually we credit warranty liability, but because it's a type of provision, so we are giving it a head of provision, 1,915. Then they have utilized the provision, means how much claims came they were for 2030. So provision gets debit and cash gets credit because you met the claims. Now in 2011 we did not make the provision, we have written back the provision. So provision account will get debit. One second, let me take you over there. Yes, provision account will get debit and other income will get credit because we cannot credit warranty expense because expense are closed at the end of the year, so nothing is there in warranty expense account. We actually need to create a new account for the reversal, that is other income. And then provision utilized during the year were 711, so provision liability gets debit and cash gets credit. Then they are asking us some more details part. This is the answer for point number A. We'll go back to point number B. Point number B says that what is meant by provision made and provision written back, which I just told you. Provision made is the recording of new provision and provision written back is the reversal of the provision because of the over provision in last year. What does provision utilized means? These are the actual claims which company has facilitated during the year. Describe what happened in 2011 regarding the creative provision. So if you remember, in 2011 you have done the reversal of provision because you over provision in 2010. That's why you corrected it in 2011, and because of this provision written back, the ending balance of 2011 is less than the ending balance of 2010. So this is it about our discussion for provisions, or you can say provision and contingencies. I wrote down these answers for you. You can just go through them. See you with the next recording soon. Take care everyone. If you have any questions, you can write them in the comment section. I'll come back with another recording of pensions soon. See you. Take care.